In the first quarter of 2025, gold didn't just rise, it detonated. We're talking about an asset that's been traded for 5,000 years, suddenly moving like a meme stock on steroids. The price broke through $2,800 an ounce, then $2,900, then crossed $3,000 for the first time in human history. This wasn't a slow grind. This was vertical. And here's the part that should make you pay attention. There was no war, no pandemic, no banking collapse on the front page. The financial media called it a safe haven rally, as if those three words explain anything. They don't. They never do. What happened in the gold market in early 2025 wasn't just a rally. It was a rewriting of how capital flows work. And by the end of this video, you'll understand exactly who moved first, how the mechanism works, and why this pattern has happened before. This is Jack Goldsman.
If you're watching this and you own gold, physical, ETF, mining stocks, futures, you need to understand what I'm about to show you. If you don't own gold and you're wondering whether you missed the boat, you need this even more. Subscribe now. Not because I'm asking nicely, because the information in this video is the kind that gets buried under headlines about interest rates and inflation expectations. The real story is never the one they put on the chyron. This is not financial advice. What this is a reconstruction of events that mainstream coverage either missed or chose not to explain. Let's start with the timeline, because the timeline tells you everything. In late February 2025, gold was trading around $2,800. Elevated, yes, but stable. The market had digested the Fed's pivot talk, the geopolitical tensions, the tariff threats. Everything felt priced in. Then something changed. On a Tuesday in early March, gold jumped $40 in a single session. No major news catalyst, no emergency Fed statement, just a move. By Thursday, it had added another 50. On Friday morning, before most retail traders had finished their coffee, gold crossed 2,900. The following Monday, it touched 3,000. 4 trading days. A move that would normally take months happened in less than a week. This wasn't accumulation. This was acceleration. And here's what the financial media didn't tell you. The futures market saw massive position changes in that same window. Open interest patterns shifted in ways that suggested large players were repositioning, not just riding momentum. The question isn't whether gold went up. The question is why it went up so fast, and who was already positioned before the move began. Let me explain the mechanism, because this is where it gets interesting. There are 2 gold markets. Actually, there are more than 2, but for our purposes, there are 2 that matter. The first is the paper market. This is where futures contracts trade, where ETFs like GLD operate, where most of the daily volume happens. The paper market is leveraged, liquid, and enormous. On any given day, the paper market trades multiples of the world's entire physical gold supply. That's not an exaggeration. That's how derivatives work. The second market is physical. Bars in vaults, coins in safes, central bank reserves. This market is slower, harder to access, and much smaller in daily volume. Here's the mechanism that most people don't understand. The paper market sets the price. The screen you look at, the number CNBC flashes, that comes from futures. But futures can be created almost infinitely, as long as someone is willing to take the other side of the trade. Physical gold cannot be created. It has to be mined, refined, transported, stored. When these 2 markets diverge, something breaks. Think of it like this. Imagine you're renting an apartment. You pay rent every month, and as long as you pay, you have the right to live there. That rent payment is like owning a paper claim on gold. Now, imagine your landlord suddenly tells you, the building is being converted to condos. Everyone who wants to stay has to buy their unit. Immediately, at whatever price the market demands. That's what happens when paper holders try to convert to physical at the same time. The price doesn't just go up, it goes vertical. Because the physical supply cannot expand to meet the demand. In early 2025, we saw signs of exactly this dynamic. Physical premiums, the extra amount you pay to buy actual metal versus the paper price, started widening. Dealers reported inventory shortages. Central banks, which had been accumulating for years, accelerated their purchases.
The World Gold Council reported first-quarter investment demand at record levels. This wasn't retail investors buying gold coins because they saw a commercial on cable TV. This was institutional money moving from paper exposure to physical ownership. And that distinction matters more than almost anything else in this story. There is a supporting mechanism here that amplifies everything. It's called the dollar yield relationship. When U.S. Treasury yields rise, the dollar typically strengthens. When the dollar strengthens, gold usually falls, because gold is priced in dollars and becomes more expensive for foreign buyers. This is the textbook relationship. But in 2025, something broke. Yields rose, the dollar strengthened, and gold went up anyway. This tells you that the traditional correlation is being overwhelmed by a stronger force. That force is de-dollarization demand. Central banks in China, Russia, India, Turkey, and dozens of other countries have been systematically reducing their treasury holdings and increasing their gold reserves. This isn't speculation, it's in the data. The IMF publishes it. Central banks publish it. The shift has been happening for years, but it accelerated in 2022 after Western sanctions froze Russian dollar assets. The message was clear. If you hold dollars, they can be taken. If you hold gold, they cannot. In 2025, this reallocation continued at pace. Some estimates suggest central bank gold purchases in the first half of the year exceeded the entire annual total from just a few years prior. This is not a trade. This is a strategic repositioning by sovereign nations. And when sovereigns move, they don't care about the price. They care about the outcome. Now let me show you why this matters beyond 2025. Because this pattern has happened before. In 2008, during the financial crisis, gold initially sold off with everything else. Institutions needed liquidity, and they sold what they could. But within months, gold reversed and began a multi-year run that took it from under $1,000 to over $1,900 by 2011. The mechanism was the same. Paper liquidation followed by physical accumulation. Once is an accident. In 2020, when the pandemic hit, gold spiked to all-time highs. Central banks printed trillions. Real interest rates went deeply negative. Gold responded exactly as it should, by repricing higher. Then came 2022, when inflation forced the Fed to hike aggressively. Gold pulled back. The paper market sold off. But physical demand remained strong. Premiums stayed elevated. And by late 2024, gold had not only recovered, but exceeded its previous highs. Twice is a coincidence. Now, in 2025, we're seeing the third iteration. A price surge driven not by panic, but by reallocation. Not by headlines, but by structure. 3 times is a pattern, and patterns don't lie. They tell you what the system is actually doing, regardless of what anyone says it's doing. I want to talk to you directly now, because I know what some of you are feeling. If you own gold, and you watched it run to 3,000, part of you is thrilled, but another part is terrified. You're wondering, is this the top? Should I sell? Did I already miss the chance to take profits? If that's you, I understand. The fear of giving back gains is one of the most powerful emotions in investing. It makes people do irrational things. They sell too early. They buy back too late. They watch from the sidelines while the market moves without them. I'm not going to tell you what to do. This is not financial advice. But I will tell you this. The question isn't whether gold is at a high price. The question is whether the conditions that drove it higher have changed. Have central banks stopped buying? No. Has the dollar regained global trust? No. Has the paper versus physical divergence resolved? No. Until those conditions change, the structural bid remains in place. That doesn't mean gold can't pull back. It absolutely can. Corrections of 10, 15, even 20% happen in bull markets. They're normal. They're healthy. They shake out weak hands. But a correction is not the same as a reversal. And knowing the difference is what separates investors from gamblers. There's another group watching this. You don't own gold. Maybe you sold too early. Maybe you never bought. Maybe you've been waiting for a pullback that never came. And now you're watching the price at all-time highs, wondering if you missed your chance forever. I know that feeling too. It's brutal. It feels like the market left you behind and is laughing at you. Here's what I'll say. Markets don't care about your feelings. They don't care whether you bought or sold or held. They only care about supply and demand. And right now, the demand side of this equation is dominated by players with time horizons measured in decades, not days. Central banks aren't buying gold to flip it next quarter. They're buying because they believe the monetary system is changing. They might be wrong, but they have access to information you and I don't. They have economists, intelligence services, geopolitical advisors, and they're choosing gold. That tells you something about how they see the next 10 to 20 years. You have to decide whether you believe them. There's a third group. You understand exactly what's happening. You've been positioned for this. You own physical metal, not just paper claims. You understand the difference between an ETF share and a bar in your possession. And you're wondering whether to add, hold, or reduce. For you, I'd say this. The hard part isn't understanding the mechanism. It's having the conviction to act on it. Every day, the market will give you reasons to doubt. Gold will pull back. Headlines will scream about crashes. Some analyst will go on television and declare the bull market over. Your job is to separate signal from noise. The signal is structure. The noise is everything else. If the structure hasn't changed, the signal remains intact. Trust the mechanism. Ignore the noise. And never forget, paper and physical are not the same thing. Owning a claim on gold is not the same as owning gold. In a crisis, that distinction becomes the only one that matters. I need to repeat this. This is not financial advice. I'm not a licensed advisor. I don't know your situation, your risk tolerance, your time horizon. What I'm giving you is information, a framework for understanding what happened and why. What you do with that information is your responsibility. If you're unsure, talk to a professional. If you can't afford to lose it, don't risk it. This market rewards patience and punishes panic. Know which one you're choosing. Let me tell you what I believe is really happening here. The gold surge of 2025 isn't just about price, it's about trust. Or, more precisely, the erosion of trust in paper systems. For decades, the global financial architecture rested on a simple premise. The US dollar is safe, US treasuries are the risk-free asset, and the American-led monetary order is stable. That premise is fracturing. Not breaking, not yet, but fracturing. Countries that once held dollars without question are now asking questions. What happens if we get sanctioned? What happens if inflation erodes our reserves? What happens if the debt becomes unsustainable? Gold is the answer to those questions. It's been the answer for millennia. It has no counterparty risk. It can't be printed. It can't be defaulted on. It can't be frozen by a foreign government. When you see central banks buying at record pace, they're not speculating, they're hedging. They're preparing for a world that looks different from the one we've known. And they're doing it while retail investors are still debating whether gold is quote-unquote too expensive. They call it volatility. I call it the system showing you its hand. Every spike, every pullback, every headline about manipulation or bubbles, these are all surface noise. The deeper reality is structural. Massive, slow-moving capital is reallocating from paper to physical, from promises to possession, from screens to vaults. This doesn't happen overnight. It takes years. We're in the middle innings of that process, not the end. The question isn't whether you can time the exact bottom or top. No one can. The question is whether you understand the direction. The direction is clear. It's been clear for years. The only thing that changes is the speed. And in 2025, the speed accelerated. Before I close, let me leave you with this. There's a reason the financial establishment doesn't like gold. It's not because gold is a, quote, barbarous relic. It's because gold represents a vote of no confidence in their system. Every ounce purchased is a silent statement. I don't fully trust paper money. I don't fully trust central banks. I don't fully trust that the rules won't change in the middle of the game. You don't fight this hard against something that doesn't matter. You don't write op-eds dismissing an asset that poses no threat. You don't laugh at gold on television if you're not worried about what it represents. The dismissal itself is the tell. Pay attention to what they mock. It's usually what they fear.
So here's my final question for you. After everything you've seen in this video, the timeline, the mechanism, the historical pattern, the structural forces, what are you going to do? Are you holding because you understand what's happening? Are you selling because you need the liquidity or you don't believe the thesis? Are you waiting for a pullback that may or may not come? There's no wrong answer. There's only your answer, and you have to be able to live with it. Drop your choice in the comments, not because I'm curious, because saying it out loud forces you to think it through. That's more valuable than any advice I could give. If this video helped you understand something you didn't before, subscribe. Not for me, for you, because the next move in this market will be just as confusing as this one, and you'll want someone explaining it who doesn't have a vested interest in keeping you ignorant. Share this with one person who panicked during the last pullback, one person who sold at the bottom, one person who's been asking you about gold and doesn't know where to start. Information is the only edge retail investors have. Use it. This is Jack Goldsman. I'll see you in the next one.